Good morning, afternoon, or evening, ladies and gentlemen, all in crypto here, and welcome back, guys, for another daily cryptocurrency market update. Strap yourselves in, because this is going to be a jam-packed one, as always. We're going to be predominantly focusing on what you would call the macro environment. And the macro environment really has been driven by interest rates, the Federal Reserve more prominently than others, but all central banks are tightening. And we know in environments where central banks are easing, actually markets do well. And there's a very nice and clear correlation there, and vice versa. 2020 was really caused, and certainly 2021 going into 2022 was really caused by the fears and the readjustment for markets and capital based on liquidity restrictions implemented by the Fed. Now we think they are pretty much done with them. We stuck to our guns and we said they're not going to hike in this one, and we are now entering a period of sideways rates, which we have deemed. We've looked at the stock market and a number of other things, and we could do it again in this video if you want. We've looked at what the S&P typically does when rates go sideways, which we could be at the point they paused in the last meeting. They are talking about intermittent meetings. So July the 26th currently has, I think, an 80% chance, according to the markets, of the Fed doing another rate hike. I'm not convinced. However, multiple central banks came out and spoke yesterday. And actually, Jerome Powell very much said, look, we think we're going to do 2 more rate hikes. So we think that that's appropriate. Is he full of shit? And the markets kind of seem to think that. Or is he serious? And the question that I really have to that is, well, why wouldn't you have just continued to get the job done and hiked? Why would you wait a month to do the next hike? And maybe they're waiting for CPI. And this data becomes very important, certainly as we move into the month of July and we get non-farm on the first Friday, we get CPI, so on and so forth. We cover all that stuff on the channel and we'll keep you all up to date with it. But generally, one of our macro reasons for being bullish on the markets, again, which no one else in crypto talks about because they're not very savvy with the traditional financial system, is that when rates go sideways, we've shown you charts of this, and nobody's disputing it that has watched these videos. I've never seen a comment saying, oh, well, that's not the case, because it is the case. Typically, from an aggressive tightening cycle, I'll show you it once more, and then we'll get into it, or we'll listen to Jerome Powell and a number of other things. Looking at the S&P, which we have upside target for, we have killed the stock market in regards to the direction that we thought it was going in. We've been so accurate on literally even altcoins in regards to getting back in January. A lot of them are still elevated from January's levels, or are now at a point of elevation from January's levels. And like I said, the bears got very, very lucky with the Federal Reserve. So this is a point hiking sideways rates. And you can see just the environment. This was a bit of an anomaly because you had kind of a double, a bit of it's more applicable where we are now to potentially somewhere like here. But you can see, and even still, when rates went sideways here, the stock market rallied before a crash. So this is what I think's to come, guys. I think we fundamentally disagree with the bears on timing. That's really it. If you're bearish for long enough or bullish for long enough, you'll be right. We try and be a little bit more intricate in regards to how we play the markets, and we try and get out and in and avoid downside and try and capture upside. But this is what I think is to come. You're going to have a blow off. Kind of agree with David Hunter, strangely, into a crash, which is likely going to be a debt-based crash. And again, sideways rates, which we may be entering, although Jerome Powell's potentially talking tough. Again, the Fed are the adult trying to coerce the child into doing what it wants by, over-exaggerating things. Potentially, we're at that point. So let's go ahead and play the clip of Jerome Powell talking. Then we'll relate it to the markets. We'll look at Bitcoin. We'll look at a number of other things. But let's go ahead and listen to Jerome Powell's comments yesterday, which is likely why the market sold off. Or stock market didn't really do much. Gold didn't really do much. The dollar did a little bit. We'll see if it hit the targets that I set out for it in my Patreon. But yeah, let's go ahead and play the clip of Jerome Powell, and then we'll get into some more charts and some more interesting data points.
The labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So I don't get why you didn't raise rates at the last meeting, especially I think it was a surprise that it was a unanimous decision to hold rates steady when you said a majority think that they still need to go farther on raising rates.
Interesting, very interesting, isn't it? And again, surprising data on inflation. So is the Fed telling you that they honestly thought inflation would be back at 2% by now? Or is how inflation comes down a trending down trajectory like the one we've seen, where actually we think the inflation is lower than 4%? In actuality, we think it's more 2.5 to 3, 3.5 there. That kind of region in the Fed's data, the CPI lags it. I think you're going to get, just like we were spot on about predicting this lower CPI, we think you're going to get a lower one in the next print. And you can go and look at your individual commodities for this. I think oil's going to get smashed in the not too near future. Maybe that ties in with a kind of demand destructive event. But the markets just don't take him seriously anymore. And I've got to say, just listening to what he's saying, it's very contradictory. But let's go on and play the second half. Once asked, well, why the hell didn't you raise, which is my question, in this hike, in this meeting? And why are you going to do it intermediately? And why, give us some sense of what you're trying to do here.
It's really just as you get closer and closer to the goal. What we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. So, we did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them with a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike?
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way. But I wouldn't take, moving at consecutive meetings off the table at all.
So he's not committing to anything. Very politician-y, isn't it? Very bureaucrat-y, the way he's not really committing to anything. He's not saying he won't. He's not saying he will. And markets don't like the uncertainty. And that's simply why things sort of got a bit turbulent yesterday. We did look at Bitcoin being potentially a little bit weak in a more intimate structure. The stock market literally did nothing yesterday. Gold, we're still very bullish on gold. Very bullish on gold, in fact. We think gold's going to just under 3,000. We think the stock market's, S&P's going to 5. We think Bitcoin's going to 41 and then potentially, 41, 43 and then potentially 50 plus. And we think altcoins will eventually catch up and overperform. Very different from what you hear. The stock market, the dollar, we were looking for a bit of a higher push here, maybe up to somewhere in this region. But perhaps it's falling short. We'll see. So we'll see what happens. But the dollar definitely got a bit of a bid. Stock market got a bit of a, we don't really know what's going on here. Gold's seeing a little bit of an uptick today. Where are my Asian markets? Not really doing a great deal. Although some of the Asian markets, only the Japanese stock market, the Nikkei and stuff, has been doing fantastically. Bitcoin, yeah. It doesn't look bad, to be honest. Looks a little heavy, but this is strength, so this is good. So start taking these levels out and you're on to the next one. And this hasn't taken long at all. The people that continue to short and that have continued to short over the past 7 months now have just got consistently wrecked. And we maintain the status that the trend is your friend and don't be against it. We're not even looking for shorts unless it's a dead certain setup, which nothing's really ever certain. Then we don't want the shorts. The longs are going to serve you far better because you're going to be in line with the trend. So we still very much assess that everything's going in the right direction. We're very right about everything. Will we continue to be so? Well, let the chart show us. There are certain altcoins that are doing pretty crap, like Algorand, for example, which is one of our worst performers. In regards to the Fed, this is very interesting. What if I told you that you tightening policy so much that you actually loosen it? And what's Morpheus referring to here? Well, he's referring to the fact that if you think about the interest payment that you are increasing every time you do an interest rate hike to tighten monetary conditions, well, this actually brings on more fiscal deficits. more spending because you've got to make those payments. It's nearly $1 trillion in spending that the government interest payments are. We're ending up in monopoly world. Satoshi was so right about all of this. And if you don't think Bitcoin was a failure, go and look at the Lebanon pound, the Venezuelan peso, the Argentinian peso, the Turkish lira. We can keep going on and look at Bitcoin and how that's now in new all-time highs. It will follow up for the dollar. I'm certain of it. You know, I'm very, very bullish and optimistic on everything. And I think you guys should be too. And hopefully we're showing you the reasons why. Again, you know, $700 billion since they upped the debt ceiling. Wait, what? Why? You know, how we that's more money than was issued in 2008, 2009 in response to the financial crisis. We're ending up in a joke world, guys, you know, and ultimately it's not a joke because your income, your money is directly tethered to it. You need to wake up. Not many of you that watch the channel daily are already well and truly awake. And again, I massively appreciate everyone that watches this channel, that leaves a comment, leaves a like, and that's a subscriber, because you mean the world to me, guys. And it's why we do these videos. And together, we are on a blockchain crusade, and we will be victorious. On that note, I'm going to love and leave you. If you've enjoyed the content, a like is appreciated, so is a comment. I was going to, and I'll potentially do a whole video on liquidity. We looked at Gareth Soloway's comments on the fact that M2 is going down, so this doesn't really align with, this is why he's still bearish. But actually, there's multiple ways to look at liquidity. This is combining the Fed balance sheet, the Treasury, and the reverse repo market. They look very similar, don't they? But I don't know. What do I know? I'm just a crypto guy, I guess, that somehow seems to be able to hold his own against many, not referring to Gareth here. I think Gareth's actually a good analyzer of the markets, but a lot of others seem to be able to hold my own very well against, which is a bit of an anomaly, really, isn't it? So on that note, I'm going to love and leave you. Again, if you've enjoyed the content, a like is always appreciated, so is a comment. I'll catch you in the next one. Thanks a lot for watching. Stay tuned, guys. Lots of videos coming out next week.